Welcome to the program You Can Beat the Stock Market. Here I show you how you can beat the stock market. I am Francisco and today I'll show you how to beat the stock market fearlessly. And I'm going to show you 10 stocks that have beaten the S&P 500 since 2007. The fear of losing money in the stock market is a natural tendency to avoid risk, especially when it comes to finances. This can lead to overly conservative investing or avoiding the stock market altogether. The fear can trigger strong emotional reactions to market volatility, leading to panic selling during downturns or excessive caution, even in favorable market conditions. Investors with this fear might focus excessively on short-term market fluctuations rather than long-term investment goals. The fear can lead to decision paralysis, where an investor is unable to make or stick to investment choices due to the worry of potential losses. It can manifest as various behavioral biases like loss aversion bias, where investors prefer avoiding losses over acquiring equivalent gains. This fear doesn't always align with the actual risk involved. Stock market investments inherently carry risk, but a well-diversified portfolio can mitigate some of this risk. Being fearful does not necessarily mean one lacks financial knowledge or investment skills. Even experienced investors can feel this fear. Sometimes this fear can be based on irrational beliefs or misconceptions about the stock market rather than on seasoned analysis. Allowing fear to dominate investment decisions is generally not conducive to long-term financial success. It can lead to missed opportunities and suboptimal portfolio performance. Fear of losing money in the stock market can change over time with education, experience, and changes in one's financial situation or life stage. In the vibrant yet often turbulent world of stock market investing, the journey of an investor is akin to a mariner sailing across vast and unpredictable seas. Just as the sailor must learn to navigate through both calm and stormy waters, an investor needs to understand how to traverse through the fluctuating tides of the stock market. Let me tell you a story about such a journey, where the fear of long-term losses becomes a beacon guiding towards the serene shores of long-term investment. Meet Joe, a budding investor whose foray into the stock market was sparked by stories of fortune and success. Joe's initial days in the market were like setting sail on a sunny day, with calm seas and clear horizon. However, as every sailor knows, the ocean's mood is fickle. Soon Joe encountered his first storm, a significant market downturn. His portfolio, which was his precious ship in his vast financial ocean, rocked violently with every wave of market fluctuation. Each dip in his stocks was a wave crashing against his resolve, and with every drop his heart sank. Joe, like many, was riding the choppy waves of short-term market movements. He was glued to daily market reports, feeling euphoric with every gain and despair with each loss. It was an emotional roller coaster, and the fear of losing money clouded his vision. It was during one of these turbulent times that Joe met Oliver, an experienced investor with many voyages under his belt. Oliver shared with Joe an analogy that changed his perspective. Investing in the stock market, he said, is like growing a tree. You don't judge its growth by the movement of its leaves, but by the strength of its roots over time. Oliver explained that the stock market, in its essence, is a reflection of the economy's growth, which doesn't happen overnight. It's a process, much like the journey of a river from the mountains to the ocean. There will be rapids, and there will be calm stretches, but the river always moves forward. Inspired by Oliver's wisdom, Joe began to reshape his investment approach. He started studying the market's history, learning how periods of downturn were often followed by recovery and growth. He realized that his fear of short-term losses was like fearing the winter for its cold, forgetting that spring was just around the corner. Joe began to diversify his portfolio, understanding that, like a diverse ecosystem, a varied investment portfolio is more resilient. He invested in stocks with solid fundamentals, companies that were like mighty oaks in the financial forest, known for their strength and longevity. As Joe adopted this long-term perspective, he noticed a change. The daily market fluctuations still occurred, but they no longer caused his ship to sway violently. He was now looking at the horizon, his goal set on a distant future. This shift didn't eliminate the risks, but it gave him the fortitude to weather them. Years passed, and Joe's investment journey continued. The seeds he had planted with patience and nurtured with knowledge had grown into a lush growth. His portfolio, once a source of anxiety, was now a testament to the power of long-term investing. He had learned that in the world of investing, time was his ally. Joe, now a seasoned investor, often shared his history with new investors. He likened short-term market losses to passing clouds in an otherwise clear sky. Don't let the fear of these clouds make you lose sight of your long-term goals, he would say. He emphasized that investing is not just about making money. It's about creating a future. It's a journey where patience, knowledge, and a long-term perspective are the compass, the map, and the sail. The story of Joe's transformation from a fearful short-term trader to a confident long-term investor is a tale of learning and growth. It's a journey from the stormy seas of fear to the calm waters of wisdom. In the world of stock market investing, the waves of short-term losses are inevitable, but with a long-term perspective, one can navigate these waters with grace and reach the shores of financial stability and growth. This story is a reminder that in the vast ocean of the stock market, it's the long voyage that leads to the most rewarding destinations. It's a lesson that in the dance of the market's highs and lows, the rhythm of long-term investing is the melody that sings of stability and consistent returns. In the realm of investing, fear often takes center stage, particularly the fear of losing money in the stock market. This fear, while potentially paralyzing, can also be a potent catalyst for self-improvement and learning. When channeled correctly, it drives investors towards a journey of education, arming them with knowledge and strategies that can lead to more informed and potentially more successful investment decisions. And how can you understand the nature of fear in investing in the stock market? Fear in investing in the stock market primarily stems from the uncertainty and inherent risks associated with the stock market. The market's volatility can turn investment portfolios red within days or even hours, making the fear of loss a constant companion for investors. However, this fear is not just an emotional response, it's a call to action. It's a signal that there's more to learn and understand about the market's workings. The first step in transforming fear into a positive force is through education. A thorough understanding of the stock market lays a foundation for sound investing. This education encompasses the basics of how the stock market operates, including understanding stocks, bonds, mutual funds, ETFs, and other financial instruments. Knowledge about market indicators, economic factors that influence stock prices, and historical market trends is also crucial. Investors should delve into the reasons behind market crashes and rallies, learning from past events to better navigate future market fluctuations. Armed with knowledge, investors can then focus on developing robust investment strategies. Strategies vary widely, from conservative approaches like dividend investing or index funds to more aggressive tactics like growth investing or day trading. Each strategy comes with its own risk profile and requires an understanding of its nuances. An important aspect of strategy development is aligning investment choices with personal financial goals and risk tolerance. For instance, a young investor might be more inclined towards growth stocks due to a longer investment horizon, whereas someone nearing retirement might prefer a conservative portfolio focused on preserving capital. Perhaps the most crucial aspect of investment education is learning how to manage risk. Risk management is not about avoiding risk altogether. It's about understanding and mitigating it. This involves diversifying investments across various asset classes to reduce exposure to any single asset's downfall. Regularly rebalancing portfolios and avoiding emotional trading are also key components of risk management. Moreover, it's essential for investors to recognize their own behavioral biases, like the tendency to hold on to losing stocks too long or to sell winners too early, and develop strategies to counteract them. The stock market is dynamic, and so should be the investor's learning curve. Continual education is vital. This could mean keeping abreast of the latest financial news, following market trends, or even taking investment courses. Technological advancements, economic shifts, and global events can all impact the stock market. An informed investor is one who understands these dynamics and adapts their strategy accordingly. On a psychological level, education can significantly alleviate the fear of investing. Understanding the nature of market cycles, for instance, can help investors maintain composure during downturns, knowing that markets have historically rebounded. Moreover, education fosters confidence. A well-informed investor is more likely to make decisions based on logic and analysis rather than the fear or hearsay. This confidence can be the difference between panic selling at a loss and patiently waiting for a market recovery. In the unpredictable world of the stock market, fear often acts like a sudden storm, darkening the skies and churning the seas. In these moments, many investors scurry for shelter, driven by the instinct to protect themselves from perceived danger. However, for those equipped with knowledge and courage, these storms of fear create a sea of opportunities. Imagine the stock market as a bustling market, where traders from all walks of life come to buy and sell their goods. On a sunny day, the market is full of energy and optimism, and the prices of goods reflect this positivity. But when dark clouds of fear gather, be it due to economic downturns, political unrest, or global uncertainties, the mood in the market shifts. The once busy stalls see fewer customers, and the traders, worried about the future, lower their prices in hopes of attracting any buyers. This is when fear grips the market and prices fall. It's a scene of chaos and worry, but also an unseen opportunity. In this scenario, there are those who view the market through a different lens. These are the investors who understand that fear is temporary, like a passing storm. They see failing prices not as a signal to flee, but as a rare chance to buy valuable goods at a discount. It's like finding a valuable antique at a garage sale, hidden among less value items, being sold off cheaply because the seller doesn't recognize its worth. These investors know that the market's fear is causing others to overlook value, and they have the courage to act on this knowledge. Having the bravery to invest when the market is fearful is one thing, but it's the knowledge that guides this courage. Knowledgeable investors understand the history of the market, recognizing that downturns are often followed by recoveries. They have studied the patterns like a seasoned sailor who knows how to navigate through stormy weather. They look at the fundamental value of stocks, seeing past the temporary influences of fear. For them, a stock's price falling due to market-wide panic can be like a rare gem being sold at the price of an ordinary stone. These wise investors also possess another crucial quality: patience. They understand that just as the storm doesn't clear immediately, market recovery takes time. They are prepared to wait, holding on to their investments through the turbulence, knowing that the sun will eventually break through the clouds. It's akin to planting a seed and waiting for it to grow. The process requires patience and faith in the knowledge that growth takes time. They're not swayed by the fear that makes others uproot their seeds prematurely. Over time, as the market begins to recover and the fear subsides, the true value of these investments comes to light. The stocks bought at lower prices during the height of a fear start to appreciate in value. It's like watching the antiques bought at a bargain becoming the centerpieces of a collection. This is the harvest for those who had the courage and the knowledge to invest when the market was fearful. Their foresight and understanding brings them rewards that are often missed by those who flee in fear. In the world of investing, courage alone is not enough. It must be guided by knowledge and patience. For those looking to navigate the treacherous waters of the stock market, remember that fear often distorts reality, presenting opportunities for those who can see through the storm. Equip yourself with knowledge, hold onto your courage, and have the patience to wait for the storm to pass. In doing so, you may find that the most fearful times in the market are, in fact, the most opportune. In the market cycle of fear and greed, the greatest opportunities often lie hidden in the moments of greatest despair. Cultivate the virtues of courage, knowledge, and patience, a trait that can turn the fearful tides of the market into a voyage towards prosperity. The stock market is a place where people buy and sell shares of companies. Think of it like a big global shop for parts of companies. Just like the weather, the stock market can change a lot, sometimes very quickly. This can be scary, especially if you're new to investing or if you've lost money before. This leads us to a deeper understanding of the nature of the stock market, specifically its volatility. Market volatility refers to how much the stock market's value can fluctuate over a short period. Imagine the stock market as a roller coaster. It goes up and down. The up moments are when the market is doing well and the value of shares increases. The down moments are when the market drops and the value of shares decreases. It's important to remember that these up and downs are normal. Here's a key thing to remember. The stock market is often unpredictable in the short term. This means that trying to guess what will happen tomorrow or next week is very hard, almost like trying to guess the weather in a faraway city. But over a long time, like many years, the stock market tends to go up. This is like knowing that even if it's cold and snowy today, summer will come eventually. When the market is volatile, which means it's going up and down a lot, it's normal to feel worried. But it's important not to make quick decisions based on fear. Think about investing like planting a tree. You don't dig up the seed every day to see if it's growing. You give it time, water, and sunshine, and eventually it becomes a big, strong tree. If you're new to investing or if past losses have made you cautious, here are some tips. You don't have to invest a lot of money all at once. Start with a small amount that you're comfortable with. Remember, investing is usually for the long haul. Think about your goals for the future, like saving for retirement or a big purchase, and focus on that. The more you learn about the stock market, the less scary it becomes. There are many resources available to help you understand how it all works. Don't put all your eggs in one basket. Investing in different types of stocks or funds can help reduce risk. When a market gets rough, try to stay calm. Big decisions made in a rush can lead to mistakes. If you're unsure, it's okay to ask for help. Financial advisors can provide guidance based on your personal situation. Remember, it's normal to feel a bit afraid of the stock market's unpredictability, but with patience, learning, and a smart approach, you can navigate it more confidently. Just like learning to ride a bike, it might be wobbly at first, but with practice, you'll get better at it. It's good to check on your investments, but doing it too often can make you worry about the normal ups and downs. Set a schedule for reviewing your investments, like once every few months or even once a year. This way, you stay informed without getting overwhelmed by the daily movements of the market. Everyone is different. Some people are okay with big swings in their investments, while others prefer more stability. Knowing how much risk you're comfortable with can help you choose the right investments. If you're more risk averse, consider more stable options like bonds or mutual funds. The stock market has had bad days, weeks, and even years, but over the long term, it has historically trended upwards. This doesn't guarantee future results, but it's a reminder that patience often pays off. Sometimes you might lose money. It's an inevitable part of investing. Instead of letting it scare you, try to learn from it. What went wrong? What it just market conditions? Or what was there something in your strategy that you could improve? Just as you shouldn't put all your money in one investment, you also shouldn't put all your money in the stock market. Having a mix of savings, investments, and other assets can help protect you if the stock market goes down. It's important to have realistic expectations. The stock market won't make you rich overnight. It's a tool for building wealth over time. Setting realistic goals can help you stay focused and not get discouraged. Sometimes people get caught up in what everyone else is doing, like buying a stock that's popular. But just because everyone is doing it doesn't mean it's right for you. Stick to your plan and investment strategy. Investing can be emotional, but decisions driven by fear or excitement can lead to mistakes. Try to make decisions based on logic and your long term strategy. Lastly, try to enjoy the process of investing. It's not just about making money, it's also about learning, growing, and planning for your future. Celebrate your successes, learn from your challenges, and enjoy the journey towards financial independence. Investing in the stock market can indeed be unpredictable and sometimes scary, especially in the short term. But with the right approach, knowledge, and attitude, you can navigate through the volatility and work towards achieving your financial goals. Remember, every investor started as a beginner, and with time and experience, you can become more confident and successful in your investing journey. But wait, there's more. Now I'll be talking about the shocking truths hidden in historical market crashes. What your financial advisors won't tell you. I have spent a significant part of my career studying market behavior, including the dramatic crashes that have shaped our economy history. Let's delve into some of these pivotal events: the Great Depression, the dot-com bubble burst of the early 2000s, and the 2008 financial crisis, and extract the lessons they offer. The Great Depression, beginning in 1929, was not just a stock market crash but a severe worldwide economic depression. This period witnessed the most significant, longest-lasting economic downturn in the history of the Western industrialized world. The stock market crash of 1929, known as Black Tuesday, was the spark that ignited this prolonged period of economic hardship. From an investment perspective, the Great Depression is a classic example of how excessive debt, speculative investments, and economic imbalances can lead to catastrophic outcomes. The decade preceding the crash was marked by a speculative bubble in the stock market and an unsustainable credit expansion. When the bubble burst, it led to a devastating chain reaction. Fast forward to the late 1990s, and early 2000s, the dot-com bubble. This era was characterized by a surge in investments in internet-based companies, driven largely by speculative and often irrational exuberance. Investors poured money into internet startups with no proven business models or earnings, pushing their valuations to unsustainable levels. When reality set in and many of these companies failed to deliver, the bubble burst. By 2002, most of these dot-com stocks had plummeted, wiping out trillions of dollars in market value. This crash serves as a cautionary tale about the dangers of herd mentality and speculation in unproven business models. The 2008 financial crisis, triggered by the collapse of the housing bubble in the United States, led to a severe global recession. The crisis was rooted in the proliferation of subprime mortgage lending, which created a housing bubble. When the bubble burst, it led to a cascade of defaults and the collapse of several major financial institutions. The 2008 crisis highlighted the interconnectedness of the global financial system and the risks posed by complex financial products like mortgage backed securities. It also underscored the importance of regulation in maintaining the stability of the financial markets. Each of these market crashes teaches us critical lessons about investing and the nature of financial markets. Excessive speculation can lead to bubbles, which eventually burst. It's crucial to differentiate between investment and speculation. Sound investing is based on a thorough analysis of fundamentals, whereas speculation often relies on the hope that the prices will continue to rise. High levels of debt and leverage can amplify the impact of market corrections. It's vital for investors to understand the role of leverage in their portfolios and the systematic risks it can create. Markets are cyclical, and periods of economic expansion are inevitably followed by contractions. Recognizing where we are in a cycle can inform investment decisions and risk management strategies. Diversification is a key to managing risk. It's essential not to put all your eggs in one basket, whether it's a specific sector, asset class, or geographical market. These crashes underscore the importance of regulatory oversight in maintaining market stability. Regulations are necessary to prevent excessive risk-taking and to safeguard the integrity of the financial system. Investor psychology plays a significant role in market dynamics. Fear and greed can drive markets to extremes. Understanding behavioral biases can help investors make more rational decisions. In times of crisis, liquidity is king. Ensuring that you have access to liquid assets can be crucial during market downturns. A long-term perspective is vital in weathering market storms. Short-term market fluctuations can be distressing, but a well-considered long-term investment strategy can help navigate through turbulent times. Investing in assets that generate steady cash flow can provide a buffer during market downturns. Companies with strong cash flows are generally better positioned to survive and thrive post-crisis. Adaptability is crucial. The financial world is constantly evolving, and strategies that worked in the past may not be effective in the future. Continuous learning and adaptability are key to long-term investment success. Continuing the discussion on historical market crashes, it's important to delve deeper into how these events shape investment strategies and the broader economic landscape. Historical market crashes teach the critical importance of understanding and monitoring economic indicators. These indicators, such as GDP growth rates, unemployment figures, inflation, and consumer spending, can provide early warning signs of economic stress. For instance, prior to the Great Depression, there were signs of an overheating economy and excessive stock market speculation. Similarly, before the 2008 crisis, there were clear indicators of an unsustainable housing market. Monitoring these indicators can help investors anticipate potential downturns and adjust their strategies accordingly. These crises also highlight the role of government and monetary policy in both contributing to and mitigating economic downturns. For example, the Federal Reserve's policies during the 1920s, the tech boom of the late 1990s, and the housing bubble of the mid-2000s played significant roles in these events. Post-crisis, the government's response, such as the New Deal programs following the Great Depression and the financial bailouts in 2008, can significantly impact the speed and nature of the economic recovery. Understanding the interplay between government policy and market dynamics is crucial for investors. Each crisis has led to an evolution in financial markets and investment practices. Post the Great Depression, there was a significant overhaul of financial regulation, including the creation of the Securities and Exchange Commission and the enactment of the Glass-Steagall Act. Similarly, the dot-com crash led to a re-evaluation of how technology companies are valued and financed, while the 2008 crisis resulted in comprehensive financial reforms like the Dodd-Frank Act. These regulatory changes have profound implications for market functioning and investment strategies. The psychological impact of these crashes on investors cannot be overstated. They often led to a shift in investor behavior, sometimes resulting in excessive caution and risk aversion. Understanding the psychological impact of market downturns is important for developing a balanced investment approach that avoids both irrational exuberance and undue pessimism. Asset allocation is another critical lesson from these market crashes. Diversifying across different stock market sectors can help mitigate the impact of market downturns. A well-diversified portfolio can weather market storms better than one heavily concentrated in a single sector of asset class. Despite the changes they present, market crashes can also create opportunities for innovation and investment. For example, the Great Depression led to significant advancements in infrastructure and industrialization. The dot-com crash paved the way for the emergence of more sustainable tech businesses. The 2008 crisis led to innovations in financial technology and the rethinking of mortgage lending practices. Astute investors can find opportunities in the midst of market turmoil. Finally, these historical events underscore the need for preparedness. This includes having a well thought out investment plan, maintaining an emergency fund, and being ready to adapt to changing market conditions. It also means staying informed about global economic trends and geopolitical events that can impact financial markets. You won't believe how safe your money can be in the stock market. Do you have fear of investing in the stock market? Let me tell you this. While the lessons from historical market crashes are vast, covering everything from economic theory to risk management, and are essential in developing a well-rounded investment strategy, there is an urgent need to address a common concern. Do you find yourself hesitant about stepping into the stock market, fearing the risk of loss more than the potential for gain? If you're someone who prioritizes security and stability, this next revelation is tailor-made for you. Contrary to popular belief, not all stock market investments are high-risk gambles. In fact, there are opportunities within the market that might perfectly align with your need for safety and your desire for financial growth. It's a misconception that needs to be busted, and we're here to do just that. Stay tuned as we unfold the truth about the stock market and reveal how you can invest with peace of mind, even if you're naturally risk averse. This could be the game changer you've been waiting for in your investment journey. One key point to consider is that there are individual stocks and sectors within the market that have historically outperformed broader indices, like the S&P 500. These stocks often belong to companies with strong fundamentals such as solid earnings, consistent growth, and a stable market position. Investing in such companies could offer the potential for higher returns while still aligning with a more cautious investment approach. The S&P 500 is organized into sectors and industries to classify the types of businesses that make up the index. This classification helps investors understand the composition of the market and make informed investment decisions. There are 11 sectors: communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. Each sector is further divided into industries, providing a more granular view of the market. For example, within the healthcare sector, you might find industries like pharmaceuticals, healthcare providers and services, and healthcare equipment and supplies. And I have made an unbelievable discovery. I found 141 large cap stocks outperforming the S&P 500 on December 4th, 2023. I'm gonna show you 10 of these stocks now. I analyzed the price change of all of them in relation to the S&P 500 from January 3rd, 2007 to December 4th, 2023. While the price of the S&P increased only 222.7% in this period, some stocks increased twice as much as the S&P 500, others increased up to 3, 4, 5 times as much, and there is one of them that increased 22 times as much. Brown& Brown is a company that belongs to insurance brokers industry and the financial services sector. Its share price increased 428.2%. Ares Management is a company that belongs to the asset management industry and the financial services sector. Its share price increased 488.1%. Fastenal is a company that belongs to the industrial distribution industry and the industrial sector. Its share price increased 579.7%. BYD is a company that belongs to the auto manufacturers industry and the consumer cyclical sector. Its share price, BIDDF, increased 590.5%. Amcor Group is a company that belongs to the engineering and construction industry and the industrial sector. Its share price increased 662.7%. Ark Capital Group is a company that belongs to the insurance diversified industry and the financial services sector. Its share price increased 991.7%. Cintas is a company that belongs to the specialty business services industry and the industrial sectors. Its share price increased 1,297.7%. Deckers Outdoor is a company that belongs to the footwear and accessories industry and the consumer cyclical sector. Its share price increased 3,372.4%. Chipotle Mexican Grill is a company that belongs to the restaurants industry and the consumer cyclical sector. Its share price increased 3,794.6%. Monolithic Power Systems is a company that belongs to the semiconductors industry and the technology sector. Its share price increased 4,938.9%. That's 22 times as much as the S&P 500. Remember, these are only 10 out of 141 large cap stocks outperforming the S&P 500. And I didn't even mention mid cap and small cap stocks. There are definitely over 200 stocks that beat the S&P 500 And the reason people don't notice these stocks is that the media has spread the fear of investing by saying that 90% of people who invest in stocks can't beat the S&P 500, so you could only invest in stocks through 401ks, financial advisors, mutual funds, and ETFs paying generous commissions to the managers of these funds. And if you want to learn how to beat the stock market so you can retire early, or just achieve financial goals faster, like buy a home, fund an education, buying a Ferrari, or whatever you might choose, hit the like and subscribe buttons and turn on notifications. Until next time, and happy stock investing.